Hi, in this video we will build a strategy using a currency pair of USD INR. So this strategy will be based on the CDS segment. It will be built on the CDS segment, which is the currency derivative segment of the NSE. Now the strategy that we will try to build will be an option buying and scalping strategy specifically for USD INR. However, the same strategy can be applied to Euro INR, JPY INR, and so on. So this strategy is not mine. I have found this strategy in a great webinar session conducted by Kotak Sec. And in this webinar, they cover why short straddle and short strangle based strategies on currency pairs do not work. After that, they have covered this. They have given this one table based on which I have built the entire strategy. Now, the idea out here is that we are basically using the CDS segment to take a trade, and we are having a very small target, very small stop loss by which we are jobbing or we are scalping using this particular strategy. So let's try and understand first how the strategy works, and then we will try to build its targets and stop losses for the same. Um, Now, in this strategy, we are basically looking at a very simple technical indicator. Now, you can use any particular technical indicator that you like. I'm using super trend. So, in this strategy, we are basically looking at the value of the super trend. So, let's say if the super trend is green in color, how do we find out if the super trend is green? We are basically looking at the close value of the candle. So let's say if this is a candle and the last close, the -1 close, is basically more than the super trend. This means that the super trend is green, and this indicates an upward movement in the market. So if there's a green color super trend, we will basically be buying a call option. And in if the opposite happens, wherein let's say if there is a the close value is, let's say, below the super trend, which means that the super trend value is red. In that case, we will be taking a short trade, which means we are essentially buying a put option out here. So that is the whole setup. Now, after taking our entry, we are basically looking at a very small target, very small stop loss. So let's assume we took an entry when the market was at 82 rupees. So let's say the USD INR was at 82 rupees, and we took an entry into the call, which was at the money, which was at 82, and we paid a premium of, let's say, around 0.0500. So once we pay this premium from our pocket, we are now going to look at a very small 0.0025 point movement in the same. So if there is a movement in the instrument, the call instrument, of anything more than 0.0025, in that case we will be exiting from the strategy, whether we are in a profit or we are in a loss. And this we will continue every time each candle happens. So on each candle we will be taking the same trade, looking for that on the law of larger numbers. The technical indicator will basically help us make a better return using this, with a significantly high number of trades. Now, this strategy has been built on a logic of 1,000 lots, but I have used it on one lot. If you want to use it for 1,000 lots, you can just increase the quantity from here. You can just increase the quantity of the lots from here. Now let's first understand the conditions that are built. The conditions out here are quite straightforward. We will first be checking for the super trend value and the close value. So we are currently looking at the instrument name of CDS. The CDS will be the exchange, and USD INR, and then within that we will be looking at the current week expiry. So we'll be using current week expiry, and if we are now checking that if the close value is basically less than the super trend value, in that case we are taking a long trade, and if the close value is more than the super trend value, we are taking a short trade. Our second condition is basically to check if there is no open position in the strategy. There are some other conditions which we will get to in some time. Um, After once this kind of a setup happens, we are basically going to take a buy trade in a call, and after taking a buy trade, we will basically make a runtime variable where we will capture the entry time. Why we are capturing the entry time is something I will come to in some time. After taking our entry trade in the call option, the ATM call option, we are now going to look at the exit condition. Now the exit condition is a simple absolute keyword. Now I'm using absolute so that I don't have to deal with a negative number. And within the absolute keyword, I'm using a math operation. So in my math operation, I'm checking the difference between two things. One is the LTP of the option that we traded. So let's say if we traded the 82 rupee call option, so we'll be looking at the LTP, current LTP of the 82 rupee call option, and we will be looking at the entry price. So our traded instrument will basically give us entry price, and the operator will be a subtraction. So we are looking at a subtraction of the LTP and the entry price. And by this difference, we will get to know that if the difference at any point is crossing 0.0025, in that case, we will be exiting whether we are at a target, whether we are at a profit or whether we are at a loss. So that is the logic that we are trying to build out here. Now coming back to this second part of the strategy, this is basically the short part, and now we will understand what exactly is this separate piece of code that I've added. Now it is very possible that let's say our entry is taken based on this particular candle, the -1 candle at let's say 9:30. So let's say at 9:30 we took our entry, and after taking an entry within let's say 1 minute or 2 minutes, our target or stop loss was hit. So that 0.25 small target and small stop loss happened immediately in let's say around 1 minute. So at 9:31 we had a target. In that case, we don't want to take a re-entry. We want to wait for the next candle to happen. So our next entry should only happen at 9:35 and not based on the 9:30 candle. Since we are looking at the position -1 candle out here in the entry condition, it is very much possible that it would take a re-entry. To avoid a re-entry, I have basically made a variable which is called the entry time. So by capturing this entry time as a variable, I know the time at which my first entry was triggered. Now I'm using position detail to check if it was my first trade of the day. So if it was the first trade, then I don't want to have any restriction. But if it is not the first trade and it's a re-entry, then I will use position detail is not equal to 0 to check if it is a re-entry. And if it is a re-entry, I'm checking if the entry time, let's say if the entry time was 9:30. So if it is more than let's say 5 minutes after 9:30. So let's say if it is 9:35, in that case, I would happily want my second entry to happen. If it is anything less than 9:35, 9:34, 9:32, then I don't want my re-entry to happen. So that is pretty much the logic that we are trying to build out here. Now our exit logic for the same set is also the same, where we are basically looking at the difference has to be more than 0.0025 in premium value. Now the only difference is that I'm using set number 2 as my set out here because I'm looking at the second set. So in my LTP and in my traded instrument, I have set number 2 that is added out here. And then I have my universal exit to basically trigger a square off at 450 every day. And then I have my standard advanced settings for all the other necessary information. And I will update the strategy. So I hope the strategy on my USD INR options helped you. If you have any queries or if you have any suggestions on topics that we should cover in future videos, feel free to drop it in the comments or drop it to us as an email at support@tradetron.tech, and we would be happy to take it up in future videos. Thank you very much. Goodbye.